When you're working with a client in an advisory role, there's nothing more frustrating than trying to do a budget versus actual or use some kind of budget or forecast that has just been thrown together really haphazardly or thrown together by somebody else, and you're trying to use it and you have no idea what it's based on. So what we want to see instead is we want to see a very thoughtful budget, one that has actually been thoughtfully put together based on the client's individual economic drivers. And so that is what we're going to talk about today. So this video today is going to be on how to uncover drivers through client communication. I will quickly reintroduce myself. My name is Hannah Smolinski. I'm a CPA and a fractional CFO. I own Clara CFO Group, which started in 2017. And in 2022, we implemented Jirav across all of our clients so that we could do all of our financial planning for them in this structured system. So we've been working for a number of years now with clients, like having these conversations and putting them into models in Jirav and building models specifically for our clients so that we can run their budgets and create new budgets every single year. So as working as a fractional CFO, I have seen business owners and even accountants put together budgets based on what they hope to see or what they think might happen, but they don't really do the underlying work to really put together a budget that is based on economic realities. They might want revenue to be $10 million next year, but when we look at the actual growth rate, that might be completely out of the question. Or they might be thinking that their COGS percentage is 25%, but then when you look historically, it's never been less than 30%. And they're hoping that they can get it down to 25, but they've never actually had an example of a year or any kind of indication that they can actually reach that COGS percentage. So, sometimes this wishful thinking, and entrepreneurs do this all the time, where they are really hoping they can make something happen. And so they put these wishful thinking numbers or these very optimistic projections into a budget. But a lot of times those numbers don't actually have any underlying support. So what we want to be able to do instead is we want to be able to build our budgets based on drivers. And these are going to be basically activities that the business is doing that are going to have a financial impact. And we want to marry that with what are the goals of the business so that we can understand the activities that are going to need to happen and the relationships between the financials, the financial relationship or the activity relationship, so that we can build a model that's going to be able to grow and scale with the business, and that we're going to be able to have the proper inputs in order to project out the proper numbers. So I'm going to give examples. I don't want this to be vague. I want it to be really clear for you guys. And what this video will be about is going to be helping you uncover, by asking the right questions to your clients, what are the things you need to be listening for so you can say, oh, that is an economic driver, or that is a driver of revenue, or that is a driver of this particular expense. And when you start identifying these things because you're having the conversations, you're going to start hearing more and more, and you're going to be able to kind of practice and continue to build a better and better model for your client. So in another video, we're going to talk about some specific use cases and some specific scenarios of certain businesses and the types of custom tables and the types of custom drivers that have been built into the model, so we can kind of put this into practice. This video, though, you're going to be using your personal skills, you're going to be using your listening skills when we talk about actually having conversations with clients. But this video is going to be giving you really practical questions that you can go and take to a client if you're having an intake meeting, or maybe you've been working with them for a while and you're trying to, maybe you're going into budgeting season and you want to sit down and start creating a budget with them. This is a useful tool for you. So we're going to put questions on the screen. None of this is meant to be like copy and paste. It's meant to be, here are some prompts that you can then tailor and modify to your client, because I'm going to give you very generic answers and you might want to put more context into that question before you actually ask it to your client, okay? Because some of these, you might have a client looking at you like you're kind of stupid if you ask them directly this way that I'm asking you, because you might have a lot more context for the question before you ask it. So I want you to use what you already know about the client and then marry it with some of these kind of generic questions so that you can tailor it to a really good conversation so that you can uncover really powerful drivers for your financial models. All right, well, let's go ahead and hop into the slides. Okay, so let's get into why first do these conversations matter? And I think that it's really important to think about why you don't want to skip this part of the discussions with your clients. Because when we gather this information, we're going to be able to not only provide a better financial model, but we're also going to be showing the client that we understand what their business really is. And we are trying to understand what's really going on in their business. And that is going to do a lot of things for us. So the first thing that it's going to do is it's going to be able to align the assumptions we use in our forecasting and in our budgeting with the client's reality. It's not going to be this wishful thinking. It's not going to be hope. We're going to be able to take direct conversations we've had with clients and put that into the financial model. And if things go awry and actuals change from budget, dramatically, we'll be able to at least know like why we had that assumption to begin with. Oh, because we had this conversation with the client and they said XYZ, but what actually had was, ABC. So it is going to be able to help us make sure that we can anchor in reality. The second thing that it's going to do for us is it's going to have increased engagement with the client. Now, when you get to have conversations with clients are very important times for you as an advisor. You get to show up, you get to present yourself in a way that is, you're here to help the client, you're here to help them succeed. And when you get to ask these questions, they are starting to get to know you better and you're getting to know them better. And it's going to just start and help have a really good kickoff for a good client relationship. Additionally, like as you work on something like a budget or a forecast, there's going to be some back and forth. There's going to be some conversation, some updates to the forecast, some review back to the client. So it gives you an opportunity for increased engagement. Doing this work is actually going to be able to help you create models that not only look impressive, but they actually will be useful to a client. Now, you can have a very fancy budget and model put together, but if it doesn't actually base itself in reality, then it's not going to be helpful to the client. So it's like, well, why do we do all that work? So this work that we're going to do today in asking the right questions and having the conversation is going to be able to have that better result at the end. It's going to give you an opportunity to add additional value. So maybe if you haven't been doing this type of work, maybe if you've only been involved in client accounting services and you haven't really stepped into the advisory role, moving into these types of conversations is going to help elevate your status with the client and ultimately allow you to upsell additional services as well. And lastly, and most importantly, is that these conversations create trust, because when they know you're listening and you are putting things into their forecasts, putting things into their budget because you were listening to them, or if you remember something they said that they didn't even think to put into the budget, or they weren't thinking about when you were having a certain conversation, that they're going to appreciate when you bring something up. So let's just say that you were asking them about what their marketing expense was going to look like for this next year. And they said, oh, same as last year. I don't know. And they just kind of gloss it over and they're like, yeah, same as last year. We might be able to say, oh, well, what about that contractor that you mentioned that you were going to hire? Would you consider them a marketing expense? Is that the line item that you would put them in? Or does that go somewhere else on the P&L? Would you consider that a professional fee, or would you consider it something else? So you can have that conversation and they might go, oh, yeah, absolutely. That's a marketing expense. I can't believe I didn't think about that. Thank you for that. And, you can increase their budget accordingly or pull back some expenses somewhere else. So this is our time to shine as good listeners. And when we are good listeners, it helps increase trust as an advisor. Okay. So that's why we do it. And, we're going to have a better model. We're going to have better engagement with clients. We're going to have increased fees and ultimately better trust. So we like all of those things. Those things are very good. Good for business and good for client satisfaction overall. So we are going to uncover these drivers, and I'm going to do it in 5 separate categories. And I've grouped these questions into these 5 different categories because I thought it made sense to group questions based on the P&L basically, and then also on the balance sheet. So general business, we're going to talk about the revenue, operating costs, specifically have some questions around workforce in particular, kind of pulling that out of some of the operating costs, and then talking about the balance sheet. Okay, so What we're going to do is talk about the questions to ask, and then I will show you some examples of drivers that we might be able to uncover from asking some of these questions. Now, I'm just giving you a sampling of those example drivers that might come out of this, but I want to give you some very practical examples as well. And again, these questions that I'm showing you here are meant to be taken and tailored to your client. So I would not sit down with a client and ask, what is your primary business? Because if I didn't already know what the primary business of this business was, unless it was the first time I'd ever talked to them and I'd never looked at their website or anything like that, I might get an eye roll from the client because I should know that as being an advisor and as being a professional coming to them. So you would want to make sure that you have the right context for this question. But I'm almost asking you as the practitioner to think about what is their primary business, and you can start to think about what drivers there might be so that you can ask these questions, all right? So some of these questions are for you to ruminate on yourself, and then some of them are for the client. So what is their primary business? Because whatever that operation is going to be is going to reveal a lot about the underlying cost structure. Where do they operate? So this is a good question to ask a client if you just started working with them. In what locations do they have operations? Do they have profit centers somewhere? Do they have cost centers? Do they have operations overseas? Do they operate in multiple states or just one location? Are they in one location but multiple units like a franchise? All of those things are really good for you to know so you can understand like what your scope might be and how big you need to build your financial projections and how big you need to build your financial model. What are their revenue streams? We're going to talk more about revenue. I have a whole section for revenue. Do they have key customer relationships? That could potentially be a driver. What if their key customer relationship is now in a country that has some trade wars going on with the US, for example? Or what if their key customer relationships are being impacted by some other kind of economic force? So it's good to know if their business is heavily reliant on one source of product or one source of service. What are their key resources? If you're working with service businesses, their key resources are probably their people, but are there a certain type of people? Are they very technical people? Or can they get, is it more like blue collar labor? Or is it entry level labor? Like, who are these key resources? Are they hard to find or are they pretty easy to find? Let's say key resources, for example, if they only hire very technical people, that might mean that they have to rely on recruiters to go out and find those people. And recruiters are more expensive than posting an ad on Craigslist or posting a help wanted sign on the front of a store. And so, thinking about how you're getting people in is going to be important. We'll talk more about workforce later. What does their competitive environment look like? That could be helpful to know. What are their industry trends? Is there anything going on this year that maybe wasn't happening last year? Do they have any kind of seasonality that you need to take into consideration? And what does the ownership structure look like? And how is the owner compensated? So these are very general, basic questions. I'm sure these even prompted some additional questions that you're thinking, oh, I don't have that question, but I have this adjacent question that I can go and ask my client. Take these, modify them, and bring them into client conversations. From those general business operations questions that we asked, here's an example of either just some good information for you to have or actual drivers that could be identified from those questions. So maybe you found out that there are separate revenue streams. So that's going to mean that you're going to need to dive deeper and get and see what is driving those different revenue streams. Do they have a service component? Do they have a product component? Do they sell to wholesale and resell? Do they sell, something that's manufactured that's going to have work in progress? Or do they sell just raw materials as well? Like there might be multiple different revenue streams for a business, and those might operate really differently. You might figure out that they have a very set cost of goods sold as a percentage of revenue. That would be a driver. You might find that they have a major slowdown every year in January and February. That's their slow season. You could see this from reviewing historical financials, but as you talk with the customer, you identify that they know that they're going to be typically down 50% from all the other months in January and February. So that would be a really good thing to know as you plan your revenue. You don't want to just take your revenue goal and spread it across the entire year. You want to be thoughtful and make sure that January and February are going to be depressed compared to the other months. Increased revenue due to increased demand for services in 2025. That might be a trend you're seeing that came out from these conversations. And then you might also identify that there's going to be increased cost because their key supplier location, where they were bringing in most of their goods from, is being affected by tariffs. So that would be a very important thing to know. If their cost of supplies has always been a certain rate, we need to make a new projection on what that would look like based on this new information that we would have from the client. So hopefully that's clear how you could, from having these conversations, just think about what would happen if you asked one of these questions. You're going to have a dialogue on that, and then ask a follow-up question, get a clarifying question from the client so that you can get really clear on what their business actually looks like. And then you can start to listen for these little pieces of like, oh, that's going to affect cost of goods sold. Oh, that's going to affect your rent in next year. Oh, that's going to affect your office supplies because you've got this, new supplier to buy your office supplies from. So all of those things you can identify through proper communication with your client. So let's move on to some revenue questions so we can understand their revenue model a little bit more. What services and products do they provide? What sales channels do they have? What metrics do they believe drive revenue? What levers can they pull to increase revenue? So let's say that they're a business that can go out and pump more money into Facebook ads and they will get more revenue. What is that ratio? If you ask this question, what levers can they pull to increase revenue? And they say, well, if we really need an increase in sales, we just go and spend an extra $5,000 on Facebook ads, and it usually gets us, $15,000 in sales, whatever that return on ad spend is. When you find out what that typical return on ad spend is, then you can build that into the model. That's a fantastic driver now that you've just uncovered that you can build into the financial projections. How do they get paid? Are they getting paid through Stripe? Are they getting paid through Square, like through credit card processing? Are they doing invoicing through QuickBooks? Like, what are those merchant service fees? Like, all of those things. When you ask a simple question, you could start to dig a little bit further so you can understand what's going to actually affect the financials. What payment methods do they accept? What's their standard invoicing terms? This is important in Jirav. You can set standard invoicing terms. Is their revenue consistent throughout the year, or does it fluctuate? Kind of similar to our seasonality question. Do they have recurring revenue? Is there something that is building over time through subscriptions or a membership or a retainer type service? There's a lot more revenue questions you could ask. There's a lot of follow-up questions to these, but here's some examples of some information that could be derived from having these conversations. So for example, maybe you found out that they have one main service is being provided, but it's being provided at 3 different levels of retainer fees. So maybe one is at $1,500, one's at $3,000 a month, and then one's at $6,000 a month. So you can potentially think about building a model that will allow calculation at those different levels based on volume of those customers. You might find out that they have one main sales channel. You could find out that revenue is driven based on number of clients and a size of contract. So the average contract value is different based on the service level. You might find that more time on business development activities and going to conferences brings in more contracts. You might find that that's how they've gotten most of their clients in the past, is every time they go to a conference, they contract with new customers. So what can they do to potentially increase, if they're trying to increase sales, can they go to more conferences? Is that going to increase our travel expense, increase our business development expenses, increase the time? Maybe we need another person. All of those things might affect the financial model. You might find out that AR is typically collected in net 30 terms, and you might find out something like your average lifetime value for a client. So all of these things, again, are just examples, but I want, like, all of this stuff is gold when it comes to building a financial model. All right, so let's get into questions you can ask around operating costs. So here are some examples. What are their most challenging cost constraint? Do they have any direct cost? Is it materials? Can they pass through that cost? Sometimes I see when we start working with a client, they don't even have any cost of goods actually identified. So they just have it all in operating costs. And maybe that's a way for us to help the client identify cost of goods sold so that we can project cost of goods sold percentage better, and also identify if we have a gross margin problem. We can do a little bit more advisory work for them there. Have they identified any areas where they want to cut costs? Will they be planning to spend more in any certain areas in the future? What costs are fixed? What costs are variable? And do they have any debt? And if so, what are the interest rates? Another thing to do with clients is to actually go through the profit and loss or the balance sheet with them directly and ask questions based on what you're observing through the entire P&L and through the entire balance sheet. So if you find that, maybe you're not getting a level of detail that you need, or maybe you have a client that is not very engaged with their numbers enough to think to answer these thoughtfully, you could walk through a P&L directly with them and say, hey, what's this line item on the P&L, and what does this represent? What costs are associated here? There can be a way to kind of do it more directly like that. I just want to give that as an option to you all. Let's go to the things that might be identified as you're going through operating costs and digging deeper into operating costs. So you might find out that labor costs are rising, that they have direct costs associated with fulfilling client services like subcontractors and direct expenses. You might find out that they actually charge a 10% fee on all pass-through costs. So those direct expenses, like maybe it's printing or it's travel, that they can pass along a fee on top of that. That can be really helpful and built in as a driver in your model. You might find out that they spent too much on marketing last year, and this year they want to bring it down by 50%. And you can have a conversation about what will make up that new amount number, how they're going to spend that money, and then you can put that into the model. And you might find out that rent increases 3% each year based on the rental agreement and the date of renewal. So you might find out that is August. So every year for August, you can put a 3% increase. And that, again, will make your model more accurate. All right, so kind of a subset of operating costs is workforce costs. So when we want to ask questions around workforce, let's think about things like, do they hire part-time or full-time? Do they hire seasonal workers? When do they hire seasonal workers? Do they rely on contractors mostly, or do they have an employment model? Do they offer benefits to their employees? And if so, which ones? Benefits can really widely vary. So they could do, something very minimal, like maybe a travel stipend or something like that, or go, all the way to health insurance, dental insurance, vision, and life insurance, 401k matching and everything, which gets much more expensive. So you need to know what they're actually offering and at what rates. What states do they have employees in? That could be really different because some states are going to have higher taxes than others, and that will affect your employee taxes. What is their payroll cycle? Is it monthly? Is it bi-weekly? Is it semi-monthly? Is it weekly? That's important so that as you're planning your model, you can make sure to get the right pay periods into the model so that, especially for people who are on bi-weekly payrolls where they might normally just have 2 payroll runs, but every couple months you're going to have a 3 payroll run. That can be a really scary thing for a business owner when they kind of forget that it's a 3 payroll month and then they have to come up with more cash to be able to cover that payroll, or they're just not anticipating having that extra draw. So that can be really important to make sure that that's built into the model. What other costs increase with hiring? So with hiring, you might have, maybe additional desks you need to buy, or maybe additional software costs, or maybe you reach a certain threshold in the number of employees that you have, and then you have to, offer different benefits based on either state requirements or federal requirements. So you need to think about what are those step ups in cost when you're hiring new employees. And you can do all of that with driver-based planning in Jirav because you can, base something basically on employee count. So you can actually, increase your benefits or some of these other costs based on employee count, which is pretty great. Is there a need to grow the workforce, or is it pretty much going to be stagnant? Are you planning to downsize? Is it something that you're looking to increase over time? You can plan that into the model. And how is recruiting done? So if you are planning to grow, how is recruiting done? I mentioned this example a little earlier in the video, but this recruiting cost can be really different based on whether or not you need to use recruiters to get new people in, or if you are placing, expensive ads for your open position, or if you're doing more free recruiting by just, word of mouth, or maybe like putting flyers up, or, hiring college kids, whatever it might be. That really makes a difference what your recruiting costs might look like. So here's some examples of things that might be uncovered during these conversations. We might identify that labor costs are rising due to inflation and higher worker expectations. That's been happening for the last couple of years. You might find that the business uses mostly salaried employees, but every now and then they'll hire some part-time contractors for projects. You might find out that they're on biweekly payroll, which means 26 pay periods per year. I would go the next further and say, hey, can you get us those months that you anticipate the 3 payrolls so that we can plan that into the model? You might find out that they offer benefits to all full-time employees and what those benefits are. Healthcare coverage of $400 per month, a 3% IRA match, $25 dental insurance, and $10 per month for vision insurance. You might also be able to identify that IT costs and software costs are $100 a month for each new hire, and that they buy one-time new desk and computer purchase for each new hire. So all these things, you could potentially start building out a workforce model that would help you if you are in a growth stage or your client is in a growth stage. You can build out these additional costs along with it. So it's not just about the $60,000 salary that a new employee is going to be paid. It's also the thinking about all the benefits and the IT costs and the desks and all of that. So you can plan for it for your cash flow, and then your client is going to feel a lot more prepared for those new hires. All right, well, let's not forget about the balance sheet, because yes, we can do driver-based planning even on the balance sheet. So let's not overlook it. We always want to take a peek at the balance sheet and make sure we know what is there and see if there's going to be any moving aspects of the balance sheet. So we need to know what do all the assets and the liabilities represent. Make sure we're really clear. If there's anything that's vague on the balance sheet, that we understand what the underlying support is for that. If you're already doing the books for the client, this makes it a lot easier. But if you're just coming in an advisory capacity, you might have not spent time with the balance sheet before. So really good time to understand the balance sheet. Do they have assets that are depreciating? And if so, what are those terms of depreciation? Do they collect AR on time? Or are they typically late? Do they have debt to service? Do they pay AP, accounts payable, on time? Do they have owners that take distributions, or are they just paying W-2 wages to their owners and their owners don't take distributions? It's a really good thing to know. And do they make tax distributions as well? So for tax payments, is that separate from the owner's distribution? So those are some good questions to ask. I also recommend, similar to what I mentioned when talking about operating costs, you can also sit down with your client and just go through the balance sheet and ask questions. If the balance sheet is not really clear and you are new to the company and you don't do the books, that's a really good time to sit down and look at the balance sheet, make sure that everybody's on the same page about what should be there. There should be underlying support for everything that is on the balance sheet, but we all know that as accountants, right? Okay, example of information and drivers that could be identified here. Let's just say maybe you found out that depreciation is 5 years for all the assets. They don't have a lot of assets, but anything that's on there is about 5 years. You might find out that they got an EIDL loan during the pandemic and that the payoff amount for that is $2,500 a month. You might find out that the owner only takes distributions if quarterly earnings are over 20%. That's good to know. And you might find out that AR is typically net 30, and they also pay their accounts payable within the net 30, typically. So those are good drivers to put into your model. All right. Well, I hope that has been very helpful for you guys as you are thinking about how to structure a conversation with your client so that you can pull out the right information and you're listening for the right information in order for you to build a better financial forecast. I'll see you in the next video.